guys, in this video, we're going to talk about the bid, the ask, the volume, and open interest found in an options chain. So we kind of got ahead of ourselves when we started talking about the option Greeks, which are the Greek words that make up our options premium. And we kind of forgot about what to look for before even looking at our options Greek. This is kind of like the most basic things to look for, to be aware of before purchasing or selling an options contract. And that's going to be your volume and your bid and your ask. Now, your open interest is right here in the left-hand column. All this means is that this is how many people are wanting to purchase or sell that contract. So that's how many people either have some sort of bid or ask in at the moment. Volume is how many contracts have been traded today. Your bid is what everybody wants to purchase it for, and your ask is what people are trying to sell it for. So if you were trying to go in and purchase, let's just say, this 65 DraftKings call in the weeklies here, you would have to pay around $62. Now, you would try to go in here and you could open this up and try to get filled at the mid price. So your mid price is going to be the spread difference between your bid, what people are wanting to purchase it for, and the ask, what people are trying to sell it for. So your mid price right now is 55. And with volume like this, with open interest like this, you can get in here around the mid price. You do not have to buy this ask. When you hear people say, oh, just go ahead and slap that ask, just go ahead and slap the bid. All that means is people are saying, pay the top price for it right now. Who cares? Just go ahead. You just got to have it now. Whereas usually you can go in and say, okay, my spread's 10 cents. All right. Ask is 70. I can probably get in here around 65, 66, something like that. Put in a limit order and you're going to get a better fill. And there's more volume. So you'll be able to do that. Whereas if we go to these 59 calls here, you can see that our spread's around $120 and your volume's only 2. So our open interest is low because nobody's really in here. Our volume's only 2. So 2 contracts have been traded all day. And you're not going to be able to get filled at that mid price at all. You're basically going to have to pay this ask, which means you're going to overpay for this options contract. And when you try to sell it, because there's no liquidity, there's no volume here, there's not a whole lot of people wanting to purchase this, it's going to be harder for you to get out. And if you do get out, you're going to get out at a worse price. So you're going to end up getting in here and you're going to pay $4.40 for this probably, but you're going to have to sell it at $3.20 just to get out. Now, why do we care about all of this? Well, it's all relative. I know how much a junky 90s Honda Civic is worth because there's a million of them. I can go to any junkyard. I can go find, you know what I mean? There's plenty of crappy Honda Civics around here. I understand what a nice one is worth, what a bad one's worth in between. I know the price range for a Honda Civic. Whereas if I'm looking at last year's Ferrari, I don't really know what the top dollar, bottom dollar is, fair value is for a Ferrari. Because there's not that many around here, we're not used to it, right? There's low liquidity of Ferraris compared to Honda Civics. So it's kind of like that with options as well. The more volume you have, you know if you're getting ripped off in here or not. You know what price you could be paying, what price you can get out of. Whereas if you have low volume, you're just not sure and you're just hoping and praying that you can get in and out of here, not getting ripped off and getting in and out very easily. Next thing to notice, your monthlies usually have your most open interest and your most volume. Now we are a couple weeks away from our monthlies here. You can see we got 2,000 down here on the 70s. Usually your nice whole numbers usually have most of your volume, 70, 65, 60, all like the 63 and a half, crazy stuff like that in there. Usually doesn't have any volume until you get into that week's expiration. See if you go in here, then you can see 63, 64, all these weird ones have tons of volume. So usually the monthlies have the most volume and the most liquidity, so you can get in and out very easily. That's why we don't like trading far out weekly. So we go to April 1st weeklies. I mean, look at this. You have no volume in here. Look at your spreads, 490 to a 630. There's nothing in there. Even though you do have some open interest, you're not going to be able to get in and out of here easily or for a right price. So that's why everybody stays with the monthlies. Usually that's what the big boys do. And or we go into this very week's weekly expiration cycle. That's also where all your volume is. So yeah, just things to be aware of, again, when trying to purchase or sell an option, always be aware of how much volume's in there and look at the difference between your bid and your ask. 5 to 10 cents, you're good. 20 cents, still good. When you get up to above 50 and $1, you're close to being ripped off. So again, just be aware of that. It's all about liquidity, trading like water, easy to get in and out. All right, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description. We also have a swing trading service if you're interested. There's going to be more information in the description below.